Hey everyone. As expected, the Federal Reserve raised their overnight rate by 50 basis points last week, taking the federal funds rate to a still low 0.75%. In addition, the Fed's making their first moves towards quantitative tightening, letting treasuries and mortgage-backed securities begin to burn off their balance sheet. These moves were well telegraphed, and it looks like Wall Street already baked them into the market. As I've mentioned in previous videos, the Federal Reserve is making a concerted effort to get inflation back under control. At its last reading, the Consumer Price Index was about 8.5%, but a new number will be released this week on May 11th. Basically, inflation is at its highest level in 40 years, and the Fed is trying to use monetary policy to rein it in. The idea is that by increasing interest rates, borrowing will be reduced and spending will slow down. That would shrink the demand side pressure that's pushing prices up. Now, some suggest the Fed started tightening a bit too late, putting the Fed behind the curve on this. But other challenges have emerged that the Fed likely hadn't factored in initially. First, the supply chain problems haven't gone away. They're in better shape today than they were 6 months ago, but China is still the #1 producer of consumer products, and they keep going through massive COVID lockdowns. Shanghai is the world's largest port. They move about 1.5 times as much container volume as America's 2 largest ports, LA and Long Beach, combined. And the entire city of Shanghai, 26 million people, has been in a COVID lockdown since March 28th. So basically, nothing is leaving the Shanghai port. Second, underlying inflation drivers like the price of oil, construction materials, housing, and wages have been rising. That's creating additional inflationary pressure. And finally, even though the cost of borrowing is going up, the US is flush with cash. Total cash savings is over $18 trillion, and for the first time in 30 years, there's more money in savings than there is in household debt. So even though the Fed's raising rates to slow things down, all that cash means it may take a while before the brakes catch. If the inflation curve doesn't flatten, investors should expect additional significant rate increases coming from the Fed's meetings on June 15th and July 27th. At this point, a 75 basis point increase this summer is not off the table. For commercial real estate, I think the story remains in alignment with my core messaging over the last couple months. First, inflation looks like it will be with us for a while, so the most inflation-resistant property types, including multifamily, self-storage, and hotels, remain in favor. Second, plan for rising interest rates. Lock in long-term debt as soon as you can. And third, strong household balance sheets will remain a tailwind for spending, supporting properties in the retail and hospitality sector. Looking at the commercial real estate transaction climate, some buyers are pushing back on pricing due to rising interest rates, but demand drivers for housing and space in most commercial property types still have a strong outlook, and new supply risk has been mitigated by the pandemic. That means the fundamentals outlook remains strong and rent growth will be sustainable for most property types in most areas. In addition, capital liquidity is still elevated. So there are many buyers and we're still in a competitive bid climate. As I always say, real estate centers on a long-term strategy, and investors remain focused on long-term yields, keeping their eyes on the horizon.